and good morning or evening, everyone, and thanks for joining us today. I hope you and your families are safe and healthy as we all continue to manage through the challenges associated with the coronavirus pandemic. While we are beginning to see the number of new COVID cases decline globally and are encouraged by the continued rollout and increased availability of vaccines in many countries, we know that millions are still battling this horrible virus. And for those of you joining us from India today, we are particularly aware of how devastating the past several weeks have been and hope that you begin to experience some relief soon. With health and safety top of mind, the well-being of our employees, facilities, and communities remains our top priority. All of our plants are operational and safely running at near capacity levels to support the needs of our customers as demand for aluminum products continues to be very strong across end markets. As a result of our ability to maintain business continuity, successfully integrate Aleris, and leverage our diverse product portfolio and global footprint, we have been able to capture this strong market demand to deliver another record quarter to close an unprecedented year globally and at Novelis. For the full fiscal year, we achieved record shipments of approximately 3.6 million tons, over $1.7 billion in adjusted EBITDA, and generated more than $1.2 billion in free cash flow before CapEx. In addition to strong market tailwinds, our teams continue to make incredible progress with the ongoing integration of Aleris, hitting key milestones related to synergies and reducing net leverage even faster than expected. At the same time, we are meeting major capital project timeline targets related to 3 organic expansions that will help us meet growing customer demand in the automotive and beverage can sheet markets. And in line with our purpose of shaping a sustainable world together, we recently announced that we will further our long-standing sustainability commitments by becoming a net carbon neutral company by 2050 or sooner, and reducing our carbon footprint 30% by 2026. We also committed to becoming a fully circular business, along with a more diverse, inclusive, and safe workplace. Moving to slide 4. As you can see on the quarterly shipment and adjusted EBITDA trend charts, a significant driver of growth in fiscal 2021 is undoubtedly a result of our successful acquisition and ongoing integration of Aleris. Since the completion of the Aleris acquisition in April 2020, Novelis has been working to integrate the business and is already realizing the benefits of the acquisition, in many cases earlier and greater than we even expected. The strategic rationale of the transaction remains firmly in place, including diversification of our portfolio with entry into the high value-added aerospace end market and the high recycled content North American building and construction business. In fiscal 2021, Aleris contributed $200 million to Novelis' total reported adjusted EBITDA. But that contribution is expected to be even greater once we return to pre-pandemic demand and are able to further drive operational efficiencies to unlock additional capacity, improve recovery, and uptime. Our teams continue to deliver against ambitious synergy targets as well. Not only have we uncovered greater synergy opportunities than we expected, we are achieving them even faster. In fiscal 2021, we have already achieved $79 million in run rate combination synergy savings. We estimate we can achieve an additional $65 million in transformational synergies by integrating our business in China. This is a result of creating efficiencies with scrap consumption and cost savings from the elimination of import duties, as well as significantly reduced transportation costs. In addition, this releases capacity in our Korean rolling mills, providing the ability to capture new market opportunities. The engineering and land study associated with a cold mill investment in China is nearly complete. We aim to begin construction in a few months and currently estimate the capital expenditures for the projects to be in the range of $325 to $375 million. Turning to slide 5, we also have significant opportunities to grow the business through organic investment, with several announced projects already under construction and further opportunities for growth yet to come. Our teams have made excellent strides in the construction and ramp-up of new capacity despite some early delays resulting from COVID limitations on contractor travel. By the end of fiscal 2021, our newest automotive finishing lines in the U.S. and China both had commissioned and begun to deliver commercial shipments. We now continue to work closely with our customers on material qualification to help meet strong automotive sheet demand. Once fully ramped up, our 200 KT greenfield expansion in Kentucky and 100 KT capacity expansion in Changzhou will increase Novelis' total automotive finishing capacity to approximately 1 million tons globally. This firmly solidifies Novelis' position as the world's largest supplier of automotive aluminum sheet. Meanwhile, our capacity expansion in Brazil to support strong demand for aluminum beverage cans also continues to progress extremely well. Installation of the new 100 KT recycling and casting line is expected to be finished in the first quarter of this fiscal year. Work also continues to make hot and cold mill rolling upgrades that will allow an increase in finished goods capacity of 100 KT by the end of this fiscal year. Turning to slide 6. In addition to investing in new capacity and capabilities, we also remain focused on getting the most out of our existing assets. 5 years ago, Novelis implemented a balanced approach to support its operations, prioritizing safety while applying a back-to-basics mentality towards manufacturing excellence and improving return on capital employed. This continuous improvement journey has yielded incredible results at our legacy Novelis plants that have significantly improved our operational and recycling performance, as well as further strengthened our customer partnerships. We have improved our customer satisfaction scores, achieving an average rating of 90% or higher every month over the past 3 years. We also reduced unplanned downtime and parts per million defects, improving the reliability and efficiency of our plants. Meanwhile, a focus on improving recovery rates in the manufacturing process released the equivalent of over 100 KT of additional capacity since fiscal 2016. These efficiencies result in a real savings, better customer relationships, and valuable contribution margin. This approach has allowed us to drive consistent improvement over the past 5 years, and we are now resetting our internal targets to include our newest facilities and acquired businesses to focus on safety, customer satisfaction, our people, and operations, as well as Novelis' environmental footprint. All of these targets will continue to drive returns and enable future growth. Turning to slide 7, while we are enhancing our environmental commitments, it is important to see where we've come from and how our purpose to shape a sustainable world together will continue to guide how we operate. As the world's largest recycler of aluminum, sustainability has always been a core part of our business. We have achieved decades of success through the long-term partnerships we have established with our customers. Since our baseline averages of fiscal 07 to 09, Novelis has achieved a 31% reduction in greenhouse gas emissions, 26% reduction in water intensity, a 40% reduction in waste to landfill, and a 25% reduction in energy intensity. Recycling and the use of recycled content will continue to be the cornerstone of our sustainability journey. Recycling aluminum requires approximately 95% less energy and therefore produces roughly 95% fewer greenhouse gas emissions than primary aluminum. Over the past 10 years, Novelis has developed more and more recycled-friendly alloys and has more than doubled its recycled content inputs, achieving 61% in fiscal 21. As a next critical step in our journey, we are making new commitments to achieve a low carbon footprint, as shown on slide 8. The cornerstone of this ambition is to achieve net carbon neutrality by 2050 or sooner, and reduce our carbon footprint by 30% by 2026. These are ambitious targets that we can achieve by working together to unlock more value and opportunity, not only for our customers and our company, but for the industry and society. We have set a number of new 2026 operational goals that will help us meet our ambition, including a 10% reduction in energy use, a 10% reduction in water use, and a 20% reduction in waste to landfill. To help ensure we reach these ambitious goals and strengthen our culture, we have also set targets and goals for our workforce. In order to reach the full potential of our organization, we are expanding our diversity and inclusion strategy and will increase the representation of women in our company, targeting 30% leadership roles and 15% in senior technical roles by 2024. It is only with the passion and dedication of a diverse and inclusive workforce that we will ultimately be able to meet our fullest ambition and maintain our position as the industry leader for innovative aluminum solutions. And now I turn the call over to Dev for a more detailed review of our financial results. Dev?
Thank you, Steve, and good morning or good evening. As a reminder, with the Aleris acquisition completed in April, the contribution of the Aleris assets from April 14 onward are reflected in our fiscal 2021 results from continuing operations. Results related to the now fully divested Lewisport and Duffield plants are reflected as discontinued operations. Net income from continuing operations increased 186% over the prior year to $180 million in Q4. Excluding tax-affected special items as outlined in the back of today's earnings press release, net income increased 12% to $172 million. This is primarily driven by higher adjusted EBITDA, partially offset by higher depreciation and amortization, mainly associated with the acquired business. Net sales increased 33% to $3.6 billion, driven mainly by a 21% increase in total flat roll product shipments to a record high 983 kilotons. The increase in shipments includes 113 KT contribution from the acquired Aleris business, as well as record can and automotive shipments in the quarter. Adjusted EBITDA increased 32% to $505 million, including a $60 million EBITDA contribution from the acquired business. This equates to a consolidated EBITDA per ton shipped of $514 in the fourth quarter. As you can see in the bridge, the improvement in EBITDA is mainly a result of this higher volume, as well as favorable mix with higher automotive shipments, favorable metal mix and spreads, ongoing cost control, and favorable FX. Partially offsetting these items is the impact of a higher fixed cost base related to the acquisition, higher freight costs associated with inflation and supply chain constraints, and some long-term incentive-related costs in SG&A. Now let's turn to slide 11 and Q4 performance by segment. Starting with North America, total FRP shipments increased 36% year over year, and adjusted EBITDA increased by 43%. This is mainly due to the acquired building and construction and other specialties businesses in the current year, as well as continued strong can and automotive shipments. Partially offsetting this was tighter metal scrap spreads on lower scrap availability compared to the prior year. Europe saw a 24% increase in shipments and 21% increase in EBITDA. This improvement was driven by the acquired Aleris business, strong can and automotive demand, and favorable metal mix. Partially offsetting these favorable factors was the timing impact of a customer contractual obligation benefit booked in Q4 last fiscal year. Turning to slide 12, Asia shipments grew 9% and EBITDA 39% in Q4. This is primarily due to record automotive shipments driving volume and mix benefits. The increase in EBITDA is also due to the contribution from the acquired aerospace and commercial plate business, favorable metal costs, and favorable foreign exchange impacts, partially offset by higher freight costs due to supply chain constraints. Lastly, South America shipments grew 8% and EBITDA was up 18% based on strong market demand for beverage can sheet supported by record production levels at our Pinda plant in Brazil, as well as favorable metal costs. These factors are partially offset by lower can pricing due mainly to prior year deflationary cost pass-through. Turning to highlights for the full fiscal year on slide 13, net income from continuing operations increased 9% over the prior year to $458 million. Excluding special items, net income was down 5% to $561 million, driven mainly by the impact of the pandemic on Q1 profitability. Net sales increased 9% to $12.3 billion, driven mainly by a 10% increase in shipments to 3.6 million tons. Fiscal 2021 adjusted EBITDA increased 16% to $1.7 billion, including a $200 million net contribution from the acquired Aleris business. In the EBITDA bridge, the impact of Aleris is evident in the higher volume and higher operating and SG&A costs. The decline in price and mix mainly reflects the impact of automotive OEM shutdowns during the pandemic in fiscal Q1. Meanwhile, disciplined cost control, combination synergy cost savings, and favorable FX also contributed to EBITDA growth year over year. Now let's turn to free cash flow on slide 14. We achieved record free cash flow generation from continuing operations of $740 million, nearly double the $384 million reported in the prior year. This is a result of record full-year EBITDA and prudent capital spending. And with strong cash generation, we achieved a significant improvement in net leverage. When we closed the Aleris acquisition in Q1, net debt to adjusted EBITDA stood at 3.8 times, and we committed to getting back below 3x within 2 years. Strong operational performance, robust demand, and good capital management allowed us to achieve this milestone a full year early, ending fiscal 2021 at 2.9 times. We also continue to maintain ample liquidity levels, ending the year with $2.2 billion. Turning to slide 15, with a strong cash balance and confidence in ongoing free cash flow generation, we made a concerted effort this year to reduce and refinance our debt profile. At the end of fiscal 2020, our gross debt was $5.6 billion, but this increased to $8 billion by the end of Q1 due to the acquisition of Aleris, which closed in April. We committed to reducing gross debt by $2.6 billion since that Q1 peak, and by fiscal year end, we have already repaid $2 billion. This includes $900 million of short-term borrowings and the full repayment of the $1.1 billion short-term bridge loan. We also capitalized on favorable market conditions and Novelis' position as the world's largest recycler of aluminum to refinance and rebalance our debt maturity profile. In Q4, we refinanced $1.1 billion of our $1.7 billion 2017 term loans through a new $500 million secured term loan maturing in 2028, as well as a $500 million Euro green bonds issuance in Europe. The remaining 2017 term loan balance will be repaid before maturity in 2022. And I'm sorry I misspoke $500 million. It's 500 million euro for the green bond issuance in Europe. Novelis' financial performance and commitment to investing in green projects not only allowed us to expand our investor base, but also has been recognized by the rating agencies, receiving upgrades by both Moody's and S&P in March. We also introduced a new capital allocation framework for Novelis to help guide our capital decision-making over the next few years, as you can see here on slide 16. First is our commitment to reinvesting in our core business to capture future growth opportunities. With strong long-term demand projections across end markets and many opportunities to invest in green projects to help achieve our sustainability goals, we have currently identified over $1.5 billion of organic capital expenditures over the next 5 years. And with a favorable outlook, we believe there could be additional investment opportunities beyond this. For fiscal 2022, we estimate that total capital expenditures will be between $600 and $700 million, including approximately $300 million of maintenance capex. The second part of our framework is our commitment to reduce gross debt by $2.6 billion from our Q1 fiscal 2021 peak, as outlined on the previous slide. As noted, $2 billion of this has already been repaid by the end of fiscal 2021. We are also targeting to reduce net leverage to approximately 2.5 times over the medium term. At the same time, we will continue to maintain adequate ongoing liquidity levels in the range of approximately $1.5 to $2 billion. And we are initiating an annual capital repatriation to our parent Hindalco of approximately 8 to 10% of free cash flow before growth capex, subject to board approval. We are now in review with our board to repatriate approximately $100 million to Hindalco in the second quarter of fiscal 2022. So with this, I'd now like to turn the call back over to Steve.
Thanks, Dev. Before we open the call up for questions, let me provide a brief product in-market outlook here on slide 18. Our near-term demand outlook across most end markets remains very positive, and we continue to work closely with our customers to adjust production based on their sales forecasts. Beverage can continues to benefit from high at-home consumption and consumer preference for sustainable packaging options. We see increased customer demand for volumes for the foreseeable future as new can-making capacity is slated to come online over the next couple of years across all regions. In automotive, a heightened OEM focus on sustainability and adoption of electric vehicles by consumers is supporting increased demand for aluminum, as well as the continued shift toward vehicle types that use higher share of aluminum like SUVs, trucks, and vans. We continue to monitor the impact the global semiconductor shortage is having on our customers, and we are prepared to meet their ongoing production needs. While we do expect to see some impact to our automotive shipments in fiscal Q1, we believe it will be relatively limited as OEMs are prioritizing their production towards larger and more high-end vehicles like SUVs and EVs that favor aluminum. In addition, our diverse customer base and geographic footprint, as well as our ability to repurpose capacity to other end markets like can and specialties, will help to mitigate the impact. Moving to specialties, customer demand for many markets are at or near pre-pandemic levels, particularly in North America. Building and construction demand is very high, supported by high levels of new home builds and home renovations. Demand for aluminum sheet in the commercial transportation segment, heat exchangers, painted products, consumer electronics, and container foil packaging remains high. Lastly, the demand for premium aerospace sheet from OEMs is expected to remain at similar levels as fiscal 2021, with recovery to come in calendar years 2022 and 2023, as vaccine rollouts are a positive step towards increasing consumer air travel. In summary, Novelis undoubtedly remains the industry-leading producer of premium aluminum flat roll products. Exceptional operating performance, Our diversified product portfolio and expanded global presence led to record results and the ability to continue to reinvest strong cash generation in new capacity and capabilities to capture favorable demand trends across end markets. At the same time, the ongoing integration of Aleris is driving significant synergies and value capture, and we are reducing net leverage. Novelis is committed to achieving our ambition to be the world's leading provider of low-carbon, sustainable aluminum solutions that advance our industry and society toward the benefits of a circular economy. We believe our contributions and leadership can effectively highlight the links between sustainability, business value, innovation, and the importance of partnerships, and lead the way of shaping a sustainable world together. With that, we're happy to take any of your questions.
Thank you. If you'd like to register a question, please press the 1 followed by the 4 on your telephone. You will hear a 3-tone prompt to acknowledge your request. If your question has been answered and you would like to withdraw your registration, please press the 1 followed by the 3. One moment, please, for the first question. And our first question comes from Sumangal Savasya with Kotak Securities. Please proceed with your question.
Yeah, thanks for the chance and congratulations on a good set of numbers. A couple of questions. First one on the auto segment. Is it possible to share what is the volume contribution in FY21 and how do we see this enhancing given the ramp up of new facilities? And also on the semiconductor issue, is it possible to share some more color? Is it consistent across geographies and what sort of impact do we see in the near term at least?
Sure. I'll take the semiconductor question first, and I'll let Dev talk a little bit more about the ramp-up of the auto facilities. So obviously it's a fluid situation. I'm sure you've been able to listen to a number of our customers' earnings calls as well. We do, as we said in our prepared remarks, do see some impact in the first quarter, and we do think the first quarter will be the largest impact as it relates to the semiconductor shortage. Again, the models that aluminum is on, you can't look at it as a pure build rate because we've talked to our customers and understand that they will favor the vehicles of which aluminum is more significantly on, trucks, SUVs, electric vehicles, and so forth. So we think the mix even inside of auto continues to favor aluminum in this shortage area. We do also see ability to offset this through our geographical footprint and our ability to divert capacity towards other end markets. So all in all, yes, there will be some impact in this first quarter, but still feel very good about the guidance that we've put out there that will be in the upper end of that in the $500 range per ton in Q1 overall. Dev, you want to talk a little bit more about auto ramp up?
Yes, Sumangal. So I think your first question was regarding the share of auto, and the share of auto overall in volume terms has been 16% for fiscal year 21, and you have to keep in mind that the first quarter was very sharply impacted by the pandemic, with shipments dropping very significantly. But if you think about the fourth quarter, we are at 19%. Having said that, I should quickly add that I think that we have to slowly start coming off the thing about percentage of auto to the overall portfolio, because the portfolio is undergoing a shift. All parts of the portfolio are growing. And so, looking at auto as a percentage of the portfolio becomes less meaningful versus just looking at the ramp up of auto. And we are going to go to 1 million tons of capacity with the expansion of 300 KT. And the ramp-ups are going very well. To just address the other part of your question, as far as Guthrie is concerned, we are shipping in this quarter. Commercial shipments are already on from this current quarter of fiscal 22. As far as China is concerned, the ramp-up is, the commissioning is on track. Qualifications are happening very expeditiously, and we will start shipping towards the end of Q2. So everything is on track and is looking very good, both from a demand point of view as well as from the point of view of commissioning of the facilities.
Understand. That's helpful. Second question on the scrap spreads. So what we understand is it's of late been increasing again given the improved collection and also higher aluminum prices. Is it possible to confirm that? And also, if you can just explain on thumb rule basis how these improved spreads flow into our EBITDA, that would be very helpful.
Yes, Sumangal. So fortunately, we are seeing good conditions coming back as far as easing of spreads is concerned. The January-March quarter, unfortunately, particularly in North America, wasn't the greatest of quarters. But in this quarter, we are seeing things actually coming back pretty well for two reasons. One is that in North America, the availability and in general, the overall spread conditions have improved. Spreads have widened, so we are very pleased about that. Overall, higher metal prices are helping as well. You know very well that metal prices are running at record highs. So overall, we feel very good about the spreads right now. Now, the only thing that we just need to kind of keep watching out for is sporadic logistical issues. I mean, the global supply chain is in a bit of a turmoil, and we do have cases where there's a supply constraint because of all logistical issues around global supply chains, and that is sporadic, to be clear. But the overall conditions are returning to very positive, and we feel good about it.
Okay, and just one last, if I may. So it's been now almost 3 quarters we've been clocking more than $500 per ton margin. And given all the tailwinds we discussed in terms of scrap and auto volume ramp up, any thoughts on your old guidance of $480 to $500 kind of a sustainable margin? Is there a case of an upward revision there now?
Yeah, Sumangal. So it's actually 2 quarters of more than 500. Secondly, we feel good. We feel good that the $500 and around that is a sustainable EBITDA per ton. We would have been even more positive had it not been for this semiconductors issue. But having said that, we think that this quarter is well on track to continue the trend, and even beyond that, unless something very disruptive happens, we feel good about the $500 and thereabouts plus EBITDA per ton.
Got it. Thank you so much, and all the best.
Thank you.
Thank you.
Our next question comes from Matthew Fields with Bank of America. Please proceed with your question.
Hey, Steve. Hey, Dev, Megan. Congratulations on a great year. A lot accomplished in some tough circumstances. Steve, you mentioned some market share gains in your prepared remarks. I was maybe hoping you could talk about some specific markets or products or platforms where Novelis kind of won market share and kind of, how that was accomplished, and if you can kind of repeat that in fiscal 22.
Yeah, so, we feel really good about the market conditions out there. As I said in the prepared remarks, we see continued penetration of aluminum in automobiles for lightweighting, for fuel efficiency, for sustainability trends that we've been highlighting over the last couple of quarters. Same with our beverage can business in that both from a pandemic situational standpoint of a lot more take home, but truly continued trends on conversion and movement towards what we believe is the most sustainable package in aluminum. And we think those trends are here to stay, and feel confident over the next several years that we will have more opportunity to continue as an industry to gain share from steel and plastics driven by these trends that we've been talking about. So, I don't know that from a market share standpoint that we're taking more market share by any means in this. I think the industry as a whole is growing due to these trends, and as a leader, we want to obviously play a big role in that, and will play a big role in that over the next several years. And in the building and the specialties markets, a lot of that's being driven by building and construction in North America, which we talked about being at very high levels right now with new home construction and home renovations, and we see that continuing certainly through this fiscal year, and then the other trends that we've seen in our specialty business is good. Aerospace is the one that is going to take some time. This year, I think, is going to look a lot like last year from a shipment standpoint, maybe a little bit of recovery. And then we believe with the trends that we're starting to see with travel, various data points that are coming out, vaccines rolling out throughout this year and early next, that we would start to see some recovery in that business in 22 and 23, and probably getting back to pre-pandemic levels closer to 24.
Okay, that's helpful. So more like you're not talking about market share gains over your fellow aluminum peers. You're talking about kind of aluminum gains over other materials.
Yes, for the most part.
Yes. Okay. On the $1.5 billion of 5 years of growth capex, we know some big chunks that are in there. The cold mill in China, I think that's about $350. The auto line at Changzhou, remaining spend there, remaining spend at Guthrie, and the Brazil expansions. Any other kind of big chunks of capex in that $1.5 billion that you could kind of tell us about?
Yes, Matthew, I can take this. So we are really looking at a lot of debottlenecking opportunities to unlock capacity. That we have laid out plans to go from a current capacity of 4 million or pre-acquisition capacity of 3.4 to really go towards 4.5. Now, that includes the China 200 KD, but beyond that, there are debottlenecking opportunities, and examples are, debottlenecking hot mill capacity in North America, where we are hot mill constrained, debottlenecking some cold mill capacity in Europe, where we are cold mill constrained. So essentially, it's going to be a debottlenecking project, more recycling investments. We see opportunity on the recycling side, so that will be the other area of investment. So broad strokes, it will be recycling and debottlenecking for a good part, and then there will be other efficiency and return-based investment opportunities.
Okay, that's helpful. Thank you. And then on the balance sheet, you said $2.6 billion debt pay down target. You've done $2 billion already. If my math is correct, that leaves $600 million to go. You kind of highlighted the 2017 term loan as you're going to pay it before maturity in 22. That's about $600. So, is reading between the lines, is the sort of 2017 term loan going to be repaid this fiscal year, and then you're kind of where you need to be balance sheet wise for the foreseeable future?
That's accurate. So the $600 million, we think that before the end of the year we would repay that a little ahead of maturity, and that would really get us to our debt pay down program to reach the $2.6 billion that we have been talking about. It will also bring our net leverage down to levels of 2.5 or below, and that is where we would ideally like to stay. So really, from a balance sheet perspective, we are almost getting there in terms of where our target is.
Okay, great. That's helpful. And then last for me, obviously your balance sheet's in a will be in a great place post the Aleris acquisition, digestion, and divestitures. You've got some capital allocation with the dividends going forward. You've got some CapEx going forward. On the M&A front, is this a back burner thing now? Are you still looking for M&A opportunities? And kind of what else can you do, I guess, outside of automotive, where it seems like you're running up against market share concerns?
Yeah, Matt. M&A is on the back burners from any significant M&A transactions. Obviously, from an antitrust standpoint, we ran into that in the Aleris transaction, and see too many organic opportunities in front of us, whether it be for further growth in auto, for further growth in even beverage can. So we'll be focused mainly on organic expansion over the next several years. Any M&A that we do will only be a very, very small kind of bolt-on adjacency type transactions, only to help with the continued ability for aluminum to penetrate versus other materials. So nothing of any size as it relates to M&A at this point in time.
Okay, great. That's very helpful. Thanks again, and good luck this year.
Thanks, Matt.
Thanks, Matt.
Our next question comes from the line of Pinakan Parekh with JP Morgan. Please proceed with your question.
Yeah, thank you very much, gentlemen. My first question is, if I look at the broad guidance, the $0.6 billion of debt reduction and the capex number of roughly $600 to $700 million implies effectively gross free cash flow before capex of around $1.3 billion. And in FY21, it was not materially different. So just trying to understand, are we expecting a very large working capital build this year in F22?
So, Pinakan, if there's one thing we would watch for on the cash flow, it's really the impact of metal prices. And, we have always been saying that for every $100 increase in metal prices, there is an impact of $60 million. So bottom line, to your point, if metal prices had stayed at generally the levels that we saw for the most part of 21 or even higher, we would be directionally much more positive as compared to FY21. But with the metal prices going the way they are, we are just watching that cautiously. On a like-to-like basis, our free cash flow will have a positive growth, as you can imagine. But we will see where metal prices take us. I don't know whether I'm addressing your question.
No, it's helpful. My second question is slightly more medium term. Over the last few years, LME aluminum prices have been in a broad down cycle and have very rarely sustained above $2,200 a ton. Right now, LME is at $2,500 a ton. There is a lot of talk about China and the shutdowns they could do, and there is a lot of talk about the new aluminum super cycle possibly having started, or at least prices not pulling back materially. Now, for a business like Novelis, which does work on essentially a pass-through basis, if we have LME aluminum prices sustaining above $2,500, even moving higher, how does it impact business? We understand cash flows, we understand working capital, but beyond that, do certain segments get hit? Does the profitability get impacted in any way? How should we look at it, the profitability of the business in a higher LME environment?
Yeah, Pinakan, this is Steve. You're absolutely right. As our model is a pass-through of our base metal costs onto our customers, which then compete for the in-market consumers. I think as you think about it and think about the cycle of commodity increases or inflation, as I've said before on the call, we're competing against plastics, we're competing against steel and other materials that are also seeing significant increases in prices as well. So if all material prices are rising, then we're competing at in the same place as we are even at the lower prices. If you were to see aluminum prices move disproportionately to other materials, steel or plastics, then on a longer term basis, and I do think it's longer term because we have contracts and it's not as though you can change your supply chain overnight by any means, then you could see some potential for some in-market consumers that might make choices based on overall costs. In the past, we've not really seen that conversion from our customer base in beverage can and automobiles because I think it's much more about a longer-term view around sustainability, about supply chain certainty and so forth. But maybe you would see it a little bit more in some of the specialty segments more prominently in a near-term dislocation of pricing. Profitability. Again, we're passing through, and so really the thing to watch there is only how spreads contract and expand as it relates to the overall metal price itself. But we try to pass through metal as much as possible.
Understood. This is very helpful. Thank you very much.
Thanks.
Our next question comes from Karl Blunden with Goldman Sachs. Please proceed with your question.
Hi, good morning, and congrats on another strong quarter. Really good performance.
Thank you.
I just wanted to build on the prior question and had a couple questions on the balance sheet. On the prior question, we've had a really strong run-up in the price of steel, for example. And there has been a change in that market. It's more consolidated, particularly in North America. So I think there are some views out there that steel prices could stay higher for longer. Is that topic coming up with customers at all in the value prop of aluminum versus steel, where this could actually shift things in favor of aluminum and more penetration?
Yeah, not in this is run up has occurred in the last quarter or two. Again, our contracts are very long dated contracts. I think a switch to aluminum for our customers is a much more strategic choice, or to other materials would be a much more strategic choice. So it's not something that they're going to react to overnight by any means. So this isn't a conversation at the customer level at this point in time. Again, I think you got to think about it over a longer period of time. And again, dislocation between the two materials that are competing. Could that come into play? Of course, over longer periods of time. But again, I think the sustainability agenda, the low carbon footprint of aluminum, what we can provide from a ability to lightweight and continue to have the same strength properties, all this comes into play versus just a pure price. So it's not as simple as running a model that they're converting based on a differential between two material prices. These are much more strategic choices with our customer base.
Gotcha. Just on that topic, with regard to ESG, a lot of progress. You even have the green bonds out now. When you benchmark yourself, I'd be interested, what's the peer group that you're specifically benchmarking the company to? Is it to the downstream aluminum peers? Is there a broader benchmarking at the Hindalco level as well? What's driving your actions there?
Yeah, I think at multiple levels. Of course, we want to lead from an ESG standpoint inside of the aluminum space, and I think you see some great statistics as a consolidated Hindalco. We are, based on the Dow Jones Sustainability Index, the highest rated aluminum company, and that's important. But I think even more important is how we compete from a carbon footprint and a sustainability standpoint from a story as an industry versus other materials. And that's where we want to, both at the Novelis level and I believe at the Hindalco level, want to lean into that. And so, longer term, the competition is absolutely other materials and not just the aluminum peers. And as a matter of fact, we want to be helpful in the aluminum industry more than anything to bring us all together to really shape the sustainability story for aluminum so that aluminum wins versus other materials.
Gotcha. Just quickly on the balance sheet, Done a lot of good work. You're almost at your target in terms of gross debt outstanding. You do have some term loans due 25, 28. When you think about your mix between fixed versus floating rate debt, are there thoughts governing how you'd like to optimize your capital structure over the coming quarters, where it looks like we could have some rate volatility, for example, and you do have some callable bonds soon to be callable due 2026. I'm just interested in how you think about the evolution of the cap structure.
Yes. So Carla, as you have seen that, just to build the context, let me start with what we have done now. As you've seen that for the 1.7 billion, we have replaced it with 500 million of secured, and then we have done the green bonds in Europe. And generally, the thinking is that when there's minimal difference between the cost of secured versus unsecured, the preference is obviously to go for unsecured and not load secured debt. Now, we are talking about the 775 million that is coming up in 2025 for maturity. I think that as we get closer to time, we will need to assess the environment at that time and take the right decisions in terms of how we should refi, or for that matter, does it make sense to sort of repay some bit of that? It just depends upon how things are in the next 2 to 3 years to take the right call. But just to give you philosophically how we think, we will basically assess based upon the opportunity between sort of the margin between secured and unsecured, and what really makes sense for the company at that point in time, and that is what will guide our decision. That's what we can say for now. As we get closer to time, we will obviously offer more clarity.
Understood. Thanks very much for all the time. Appreciate it.
Thank you.
Our next question comes from the line of Indrajit Agrawal with CLSA. Please proceed.
Yeah. Hi, good morning. Thanks for the chance. A few questions from my side. First, in beverage can, we had a new entrant in the North America market this quarter. So did you have a chance to look at the pricing? How is our pricing versus the current market, and do you see a scope for significant uptick in prices over the next couple of years or so?
Yeah. Are you speaking of a beverage can entry from the standpoint of rolling or can making?
Rolling.
From rolling. So you're referring
Not
to
can,
Kaiser's acquisition?
Arcanix entry.
Correct.
Or
Okay,
Arcanix, the new...
and Arconic coming back in and converting their mill.
Yeah.
So
yes.
Yeah. So yeah, okay.
Yes.
Yeah. So Kaiser's not in essence, it's just a change of ownership, and so no new capacity coming on. Arconic, yes, has announced that they would be entering back into the beverage can market in North America, and the North American marketplace absolutely needs that capacity. Even with that capacity coming back on towards beverage can, we as an industry, can sheet industry, are full up trying to supply the current demand of our customers, let alone the growth that we're going to see over the next couple of years. And so we absolutely will need to work to continue to debottleneck and invest in debottlenecking activities in the North America marketplace to stay up with that demand. Obviously, with where the demand for all the reasons I've talked about earlier is moving, that will tend to lead to favorability in pricing. But again, our contracts are longer-term contracts, and will take time to come into play. But the trend would be for higher pricing over a period of time.
Sure, that's helpful. My second question is on the acquired Aleris business. This quarter, we have seen a sharp jump up in profitability, close to $50 a ton, quarter over quarter. So has there been a significant pickup in aerospace volumes, or is it more to do with the building and construction side of things?
Yeah, it's more to do with the building and construction. We are seeing some some potential more favorable orders being taken in on the aerospace, but that has not come through the business necessarily in a significant way yet. So the favorability is much more on the building and construction side.
Sure, that's helpful. My last question is on the repatriation of cash. Will there be any tax implication at Novelis level because of this repatriation, or will the entire thing will be at Hindalco level?
No, this capital repatriation that we will do will actually be pretty tax efficient. There will be no tax leakage.
Sure. Thanks. That's very helpful. All the best. I am done with my question. Thank you.
Thank you.
Thank you.
Our next question is from Vishal Shandak with MK Global. Please proceed with your question.
Thanks. Just clarification. It's DAM Capital. So, first question, Dave, this is with respect to the Duffel plant divestment. So, I believe we had some pending receivables over there, and there was a case filed. So, if you could just help us with what's the current status of that?
Well, we are right now just about in the pre-arbitration stage. The arbitration has not even started. So really not much more to say at this point in time. I think that as there is any kind of movement or progress, we will keep reporting that back. At this point, we don't have much more to report than the fact that we are still at pre-arbitration stage.
Okay. You just mentioned that capital repatriation to Hindalco would be in a very, very tax efficient manner, in which probably definitely Novelis is not going to get taxed, but would there be a tax implication on Hindalco as well, or that would also be kind of taken care of?
I think the best thing is to wait for the Hindalco call to answer this question. To the best of my understanding, the only tax implication here will be in the hands of the receiving shareholders. But I would rather defer that question, when you have the opportunity of the Hindalco earnings call.
Sure. Given the fact that the cash flows next year, where we are in respect to the metal prices, there would be sufficient cash flow which would be left even after addressing the growth capex as well as your working capital. So would there be a choice to repatriate more in addition to what we have already committed or announced so far?
So at this moment,
the excess cash should be applied to repay loans over here.
So, so let me answer this. So really, we are going to have a clear policy of 8 to 10% of free cash flow before growth capex as the amount that we will repatriate. Beyond that, there is no plan to repatriate anything more. And as far as the strong cash flows are concerned, so there will continue the growth opportunities. What we have told you is that we have identified 1.5 billion of growth capex opportunities in the next couple of years. Having said that, it's not like that's the end of the road. There will be more opportunities for organic investments that will keep coming up. So we want to keep the balance sheet ready to be able to take all those investment opportunities, and that's what the intent is going to be. But if your pointed question is that because we will have strong cash flows, will we repatriate more? No. I mean, we have been very clear that it's going to be about 8 to 10% of free cash flows before growth capex.
That's quite helpful. Thank you so much.
Thank you.
Our next question comes from Amit Dixit with Edelweiss Singapore. Please proceed.
So I had a couple of questions, mainly on your sustainability targets. So have we hit the peak carbon emission intensity because we have targeted that we will reduce by 30% till CY26. Is there a chance for your scrap usage to grow beyond 61% that we have achieved in FY21?
Yeah. So on the carbon footprint, we've committed to being a carbon neutral company by 2050 or sooner. But we've also set a near-term goal to really get us into making a very significant progress towards that, which is a 30% reduction by 2026. And we do have a lot of good line of sight towards how to get to the 30% reduction. Obviously, one of the biggest drivers is exactly where you're going, which is higher recycled content, which comes with higher recycle rates, which we'll have to work on in all the jurisdictions that we do business in. And yes, we can get above 61%. Obviously, with the portfolio of rolling growing, it's not as easy to just think about it as a percentage. It's similar like what Deb talked about with auto. Because as we're growing rolling capacity to stay up at the 61%, we're already effectively working against a more stringent target. But we can bring in more scrap into the system, and we can get above 61%. We would target somewhere in the mid-60s over the medium term and continue to push from there.
Okay. The second question is on beverage can market. Again, you mentioned in your prepared remarks that there are expansions coming up in beverage can market. So do you expect in medium term the margins that we earn will go down, or you expect demand to take care of that?
Yeah, our expectation is with the strong demand projections that we're seeing, talking to our customers and seeing due to the trends of consumers looking for more sustainable packaging options, we think this growth is something that's going to occur over the next 5 to 10 years for sure. And with that growth, and as we talked about even in North America, lower ability to stay up with that demand with the supply will come with investment, which obviously will need to come with some price increases. So our overall view on pricing in the beverage can market is for expansion of margin over the next 5 to 10 years, but it won't happen immediately.
Great, that's very helpful. The last question is on essentially green bond. So we have refinanced euro 500 million with green bond. So is it possible to share the covenants of that, or whether we would be interested in more such refinancing, green bond refinancing in future?
Right. So as far as the conditions of the green bonds are concerned, well, we don't have any major tight covenants, so to say, except for the purpose for which the proceeds of the bonds can be used. And essentially, the proceeds of the bonds have to be used for reducing carbon emissions. To that end, we have already some projects like the Brazilian recycling expansion, or for that matter, the Greensboro expansion here in the U.S., where, a part of the proceeds would get allocated. These are projects which are already under execution, and there will be more. As I said in response to one of the earlier questions, that one of the areas where we will be investing capital is towards adding more recycling capacity. Also, I should have mentioned, it's towards alternative energy. So, we have a small project, kicking off in one of our Italian plants to set up solar cells to produce alternative energy. So, really, it's going to be towards carbon reduction goals, in our case, targeted towards recycling, and also towards alternative energy. And a lot of the projects are identified. Some will get identified in the course of time. Other than that, there are really no major conditions, constraining conditions on the green bonds.
Okay. Are there plans to further issue such green bonds in future, or that's it?
Not at this moment. Not at this moment. I mean, I think that we have pretty much done what we needed to do as far as the balance sheet is concerned. But I would not like to look far beyond, sort of a time frame of the next about 1 to 2 years. So we would never say no, but in the next 1 to 2 years, there's going to be nothing beyond that. Let's see how things go.
Okay, so great. Thanks and all the best.
Thank you.
Mr. Fish, I'll turn the call back to you for your closing remarks.
Great, thank you. And apologize we couldn't get to everyone's questions today. Please reach out to Megan and follow up with us, but we are on a bit of a tight schedule today. Again, thank you all for the time today. As our financial results and outlook show, the future is, I think, extremely bright for Novelis and aluminum more broadly. And we think we're well positioned to continue serving customers with this infinitely recyclable aluminum solutions and pursue our growth strategies to advance a more circular economy. With the continued strong operational performance and these new sustainability targets and our commitment to a more diverse and inclusive workforce, the year ahead promises to be very enriching for our colleagues, our customers, and our partners. So thank you again, and I hope you all remain safe and healthy.
That does conclude the conference call for today. We thank you for your participation and ask that you please disconnect your line.